welcome. In this explainer, we're going to break down something called the Justice Fund Exchange, or JFE for short. Now, this is a platform designed to do something pretty interesting. Turn a future tax refund into capital you can actually use today. We'll get into how it works, which is perfect for financial pros, and we'll also hit all the key concepts you'll need if you're studying for a quiz on this stuff.
Okay, so here's what we've got on tap. First, the why behind JFE, its mission, and the problem it's solving. Then we'll get into the nuts and bolts of the tech. After that, we'll touch on the legal paradigm it operates in, some alternative tax law views for context, and then the ecosystem risks and integrations. We'll wrap it all up with a quick recap and some practical next steps. Let's get into it.
All right, first up, JFE's mission and the problem it's designed to solve. You know, every new financial tool really starts with a core challenge, so let's dig in what JFE was built for.
So here's the big question, right? How do you take an expected tax refund, money that you know is coming but you don't have yet, and turn it into collateral that a lender can actually finance against? And not just finance, but do it quickly and, most importantly, securely.
And this really lays out the before and after. On one side, you have traditional lending. You know the drill. Slow, lots of paperwork, and a bit of a gray area when it comes to who really has the first claim. But JFE's goal? To completely flip that. We're talking a fast, digital workflow that establishes what's called a perfected security interest. Basically, a rock-solid, first-in-line claim for the lender, all of it backed by an immutable audit trail that nobody can mess with.
Okay, this is the legal key to the whole thing. So how does JFE make this work? Well, it legally reclassifies that future refund. Under something called the Uniform Commercial Code, or UCC, it becomes a general intangible. Now that might sound like a bunch of jargon, but it's absolutely crucial. It's the legal maneuver that turns a future promise of payment into a real, securable asset that a lender can put a lien against.
Okay, so we've got the legal framework down. Now let's get into the fun part. How does the tech actually make this happen? It's a really interesting mix of old-school legal filings and a new-school blockchain backbone.
You can really break it down into 5 main steps. First, you start with the legal stuff. The borrower signs a security agreement. Then, super important, a UCC-1 financing statement gets filed. That's what perfects the lien and puts the lender first in line. And then, the tech kicks in. Smart contracts handle the money, oracles keep an eye on real-world events, and every single action gets locked onto an immutable ledger. It's a clean, automated flow from start to finish.
Let's talk about these smart contracts, because they're a huge piece of the puzzle. The easiest way to think about them is like a digital escrow agent that runs on autopilot. It holds the funds in safekeeping, and it has a very simple set of rules written into its code. It will only release that money when certain conditions are met and proven. No humans needed, no judgment calls, it just executes the agreement perfectly.
So you might be wondering, how does this smart contract, sitting on a blockchain, know what's happening in the real world? That's the job of an oracle. Oracles are basically trusted messengers. They're the services that securely feed outside information, like, hey, the IRS acknowledged the filing, or, yep, the deposit hit the bank account, into the smart contract, telling it it's time to do its job.
And here's where it all comes together. Every single one of those steps we just talked about, the agreement, the filing, the data from the oracle, the money moving, it all gets permanently stamped onto an immutable ledger. Immutable just means it cannot be changed or deleted, ever. This creates this perfect tamper-proof audit trail. For compliance, for regulators, for auditors, it's a single source of truth you can absolutely rely on.
Okay, let's shift gears a little bit. This next part gets into a core legal idea that's presented in the source material, which is really important for understanding the JFE philosophy. It's all about the distinction between what's called a public posture and a private posture.
So as the framework lays it out, these are two very different ways of operating. The public posture is seen as being more focused on the debtor and relies on typical procedures and presumptions. The private posture, on the other hand, is what this system is designed for. It's creditor-centric, it emphasizes full liability, and it's all about relying on hard evidence and facts that have been stipulated and sworn to.
So how does this private paradigm work in practice? Well, it uses some very specific tools. You've got an affidavit of obligation, which is basically a sworn statement of facts. You have a notary public to witness and formalize everything. The whole idea is to create such a solid factual record that if it ever went before a judge, their role would be purely ministerial, meaning they wouldn't need to interpret anything, just act on the undisputed facts. It leans on the old legal idea that if an affidavit isn't challenged, it stands as truth.
All right, now this next part is really important for context. The source material we're drawing from also explores some, let's call them alternative views on tax law. We're going to walk through them because they are part of the documents, but it's for the purpose of critical analysis.
So these interpretations raise questions about the standard understanding of U.S. tax law. You'll see arguments in the source material that debate the scope of the 16th Amendment, what gross income truly covers under Section 61, whether Title 26 is positive law, and even arguments around withholding agents in the idea of voluntary compliance with W-4s. Again, these are viewpoints presented for evaluation.
And this brings us to what is, without a doubt, the most important takeaway from this section, and it's a direct quote from the source material. These viewpoints are presented for critical analysis and are not legal advice. Let me repeat that. This is not legal advice. The key is to always align actions with controlling law to mitigate risk. That's the bottom line.
Okay, let's pivot now from legal theory to the practicalities of the market. The source also gets into the wider ecosystem. Think crypto treasuries and the financial plumbing this all connects to. We'll look at both the risks and the integrations. So here's an interesting risk that gets pointed out. Sometimes when a company's treasury is full of non-productive digital assets, think assets that just sit there and don't generate any yield, it can be a top-of-market signal. It could be a sign that they're just providing exit liquidity for insiders. This is a stark contrast to productive assets, things like staked ETH that are actually generating yield and being used in the ecosystem. It's a really important distinction for lenders when they're looking at counterparty risk. Now on the integration front, and this is huge for any lender or regulator watching, the JFE system isn't designed to live on an island. It's built to plug right into the existing financial plumbing. We're talking about aligning with the DTCC Replacement Implementation Guide and ACORD Insurance Data Standards. This is the big leagues. So what's the big deal about that? Well, when you align with these standards, you get clean, automated data that just flows. This is what makes things like automated underwriting software possible. It makes securitization audits way smoother. It improves what's called straight-through processing. And of course, it makes your AML and compliance checks that much more robust.
All right, we've covered a lot of ground, so let's do a quick recap to lock in these key ideas. This is perfect for a quiz review, and then we'll get to a very practical checklist for lenders.
Okay, quiz cue number 1, general intangibles. Remember, that's the UCC Article 9 category that legally turns a future tax refund into something you can secure a loan against.
Next up, perfection. What is it? It's the act of filing that UCC-1 financing statement. This is what makes your security interest legally enforceable against everyone else. It's how you get first in line.
And what about an oracle? That's the trusted service that feeds real-world data, external data, to the smart contract on the blockchain. It's the messenger.
And last but not least, the immutable ledger. That's your digital record book, like a blockchain, where every transaction is recorded permanently and can't be changed. It's your tamper-proof audit trail. And finally, to bring it all home, here's a practical checklist for any lenders or regulators out there. This is your What to File Next guide. Go ahead and screenshot this one. You'll see the executed agreements, the identity verification, the all-important UCC-1 filing, and the review of those automated reports. You know, at the end of the day, it's all about combining established law with new tech to create a better, more transparent way to unlock value. Thanks so much for watching.